Hi, I'm Jack Farley with Real Vision, and I'm here with Teddy Vallee of Pervalle Global, a global macro fund. Teddy, it's my understanding, you invest in commodities, currencies, equities, even Bitcoin. So everything. You're very pan asset, right?
Exactly, 100%. We're expanding more in the crypto space with individual coins.
Great. Well, I'm so glad that you can join us, Teddy. It's great when we can get someone who can invest in so many assets, because that way, I have a ton of questions that you can answer. I know Bitcoin, you were very early in that space, and obviously that's on a tear. So I want to get your views on that. But I know that you also have a strong thesis on the dollar, as well as tech, like growth versus value within equities. So let's start with the dollar. What's your view on that?
Yeah, I think the dollar overall is interesting. Long term, I'm very dollar bearish. I think the structural sort of things that we have going on in the U.S. Forward returns for the U.S. versus the rest of the world favor the rest of the world. Therefore, a lot of capital is going to leave the U.S. and find higher returns elsewhere. Right now, though, I think we're in this situation where everybody's negative on the dollar. Not only negative on the dollar, but they're also max long equities to an extent. From a prime broker standpoint, the Goldman Sachs net hedge fund net percentage long is 97 percentile, 98 percentile. So right now with the dollar, everyone is positioned for it to effectively be weaker, whether that's in the dollar within commodities, max long sort of cyclical commodities, max long cyclical currencies. And when you have positioning sort of set up like this, it typically leads to an unwind before you can actually have a stronger move lower. Because if everyone has the view that the dollar is going to go lower, then everyone's already positioned and sort of has that trade on, so it makes it less likely. The key thing that I think with the dollar that we're a little bit worried about is liquidity. So one of the things we track and build out is these liquidity models that lead certain asset classes. And the one specifically that leads the dollar is this Treasury issuance less quantitative easing, or QE, that the bond purchases that the Fed's doing. So right now we're looking at over the next 120 days. So this model leads the dollar by 120 days. And right now we're coming to this period where it should show dollar strength because there's been a significant amount of basically liquidity extracted from the market through these Fed or through the stimulus programs of the US government. And the Fed is not covering or buying enough of those bonds to effectively fill the gap. So if there's only, call it $100 in the system, and the US government says, look, guys, we need $20. That $20 needs to come from somewhere in that $100 if the Fed is not buying. And we have found that is very liquidity negative and affects the dollar primarily more of the developed market currency pairs like the euro, for example. So with this liquidity backdrop, everyone very negative on the dollar, everyone positioned for the dollar to continue to go lower, it seems the probabilities favor a bounce in the dollar, which I think will lead to probably a precious metals unwind, which you're sort of seeing right now. We've been very bullish on gold and gold miners up to 3 or 4 months ago, where we saw this real rates effectively moving higher. One, because of break even sort of coming in. Two, because nominals could potentially rise. But I think the probabilities right now are favor a higher dollar. That being said, if we see a breakdown through the lows, I think that view is likely wrong, and then you just need to reevaluate. So as long as we hold the most recent lows in the dollar, I think the bias is to the upside.
Interesting. And what's your time frame on that? Like 1 to 2 years?
Hi, I'm Raoul Powell. Sorry to interrupt your video, I know it's a pain in the arse, but look, I want to tell you something important. I can tell that you really want to learn about what's going on in financial markets and understand the global economy in these complicated times. That's what we do at Real Vision. So this YouTube channel is a small fraction of what we actually do. You should really come over to realvision.com and see the 20 or so videos a week that we produce of this kind of quality of content, the deep analysis and understanding of the world around us. So if you click on the link below or go to realvision.com, it costs you $1. I don't think you can afford to be without it.
So as long as we hold the most recent lows in the dollar, I think the bias is to the upside.
Interesting. And what's your time frame on that? Like 1 to 2 years?
2 to 3 months.
Okay, 2 to 3 months. So much more.
I would say through the first quarter of next year.
Okay, so
yeah,
long term, you're bearish.
More tactical, exactly.
Okay, interesting. Yeah, I want to dive into this chart that you have of the cumulative QE minus the Treasury issuance relative to the dollar. Can you just explain the dynamics and sort of, what's on the right side of what's on the right side of the chart and what's on the left side of the chart in terms of like the denominations?
So year on year, though, I can tell you, I think is on the right hand side. So the dollar year on year, so the percentage, that it's rising or falling over the prior year. And then the left side is effectively the amount of Treasury issuance that the Treasury is doing versus the amount of bonds the Fed is buying. So we accumulate that over time. So, if it, for example, in 1 month, if it's $100 of net Treasury issuance greater than QE, that'd be $100. The next month is $50 net positive. So that effectively over time, and then take the year on year of that. So you're looking at the relative changes and rate of change of these liquidity profiles, not necessarily the absolute level, which we found is a pretty good lead of the dollar and liquidity overall.
Interesting. I find that to be such an interesting chart. And just so the blue line is that QE minus the Treasury issuance, and it's denominated negative. So the higher it goes, that means the more Treasury issuance there is relative to QE, because
correct
Treasury issuance, when they issue a bond or a bill, primary dealers have to buy that, so that sucks cash out of the system. Whereas when the Fed buys bonds from the Treasury or from primary dealers, they inject cash into the system. And I was really fascinated by this chart, Teddy, because I, like so many, including probably some of the viewers, have been heard this narrative that the Fed has injected unprecedented liquidity into the market. But you're saying, sure, they have, but relative to the amount of Treasury issuance there's been, it's actually liquidity net negative. Is that what you're saying?
Correct. So the way the mechanism of sort of the timing there is when the Fed does come in with those programs, the positive amount of, so for example, early this year, the positive liquidity effect of that was unbelievable because the QE relative to how much they were issuing was incredible, like 500 billion in excess, QE in excess of the issuance. We are now financing a lot of, one, the deficits, and two, some of the stimulus programs, which then, so while it was liquidity positive, now we're paying it back effectively and having to pull that money from the market to finance, these stimulus projects. And this is, we can touch on this a little bit later, but I think this concept and how this, the dynamics of this are extremely important for the next, I think, 10 years, because you're effectively taking money out of the market via Treasury issuance to then give to, either infrastructure, either stimulus payments. And I think we might have one more sort of round of positive monetary policy in terms of rates coming down, being positive for growth. But after that, you're sort of on the lower end and you don't have much room to go on the monetary side. Therefore, fiscal becomes the new monetary policy. And if you have to finance everything via the Treasury market, liquidity negative, to then give out and push out to consumers, to businesses, et cetera, that's growth positive, liquidity negative. Therefore, that's commodity positive, financial asset negative. So we're creating this feedback loop, or with the beginning of this feedback loop, that over a longer term period significantly favors commodities, hard assets over financial assets, particularly U.S. tech, which I'm not very keen on.
Yeah, let's talk about tech. What's your base case? Over this year, we've seen tech explode higher as lockdowns have happened. People have been working from home. They haven't been going to stores. They've been ordering online. They've been using Zoom. You and I are using Zoom right now. That's obviously been a very good environment for tech. What's your view on tech going forward? And I think I sort of portrayed it the way that you would see it sort of on CNBC in terms of it's a very clear narrative, but I think you have a more nuanced view about where tech is relative to the dollar. So just tell me your view.
Yeah, so I think overall, let's start at the beginning. The liquidity that came into the market was unprecedented, and that led to the dollar going lower. And as the dollar went lower, that really ripped break evens. So real rates, given that nominals didn't move, because the overall growth backdrop was still very poor, real rates went through the floor because break evens, inflation expectations rose off of a lower dollar. That led to over 100% increase in the market because the multiple of the market, primarily technology, rose. It was the whole factor of the gain from the March lows, not necessarily, well, not at all from earnings growth. It's all multiple driven, which was due to lower real rates. So we have a chart, which I'll send to you, which you may even have, that shows real rates versus the S&P multiples. So the growth that we've had, the appreciation that we've had, has primarily been from one, liquidity, and two, lower real rates. Both of those factors that drove tech, I think, now are fading. And as a percentage of the total, and I can get into that in a second, and it's a percentage of the total market cap. Tech's about now $11 trillion and about 31% of the total market. If you look at some of these other sectors, energy, for example, it's up a decent amount over the past few weeks. But at the time that the report that you're referencing that we sent out last month, it was about 600 billion. So if you get any flow from tech, which is 11 trillion to a 600 billion market cap, the moves are huge. And this is sort of what we're outlining in that piece. And then, we got the vaccine news, and energy has had some serious moves because everyone's underweight it. Everyone's overweight tech. But as it relates to tech, I think the probabilities are that real rates are going to go higher. And if real rates go higher, you do not want to own these growthy names. Now I can get into why I think real rates are going to go higher, but tech, I think everyone's overexposed to it. It reminds me a lot of 2000 in the sense that everyone's long it. It's the exact same percentage of the market cap. Everyone's raving about it, how we're all going to work from home forever. To me, the things that were positive for the space overall are very negative going forward, and will continue to be negative going forward. And I think it becomes a funding not currency, but funding source to pair against other sort of cyclical sectors, but also parts of the world. And there's been so much capital that has come into it over the past 10 years because the growth profiles have been horrible. There's been really, nowhere else to put your money. For example, Tina, there's no alternative. And I think that situation is changing, and we're coming into an environment that looks much different.
Teddy, okay, that's so interesting. Can we dive into it a little bit on why low real rates are good for tech?
Yes, absolutely. So effectively, when you have a lower real rate, that in a sense is liquidity positive, but it also means that lower real rates mean that the growth profiles of the economy are very poor. Higher real rates means that nominals are growing in excess of the inflation expectations, which is positive sort of cyclicality. So as real rates go lower, that means that investors effectively do not have the same rate of return or a lower rate of return on sort of the cost of money. Therefore, they are more willing to pay up for something that actually has growth when the growth backdrop is very negative. Hence why you've seen this monster influx into tech and why tech is doing so well. The growth backdrop's been poor. Real rates have gone down. Break evens have gone up primarily because of liquidity. I think that's changing in terms of sort of the driver of the break even itself.
Yeah, and Teddy, sorry to interrupt.
Yes, please.
So can you tell people what a break even is?
It's effectively the market's view of what inflation is going to be over a certain time period. So 10-year break evens is what the market's expecting the future inflation gauge to be 10 years from now. So it's the market's way of deriving where, call it CPI is, which I don't love. I think it's always important to focus on the break-even market because at the end of the day, which is derived from the TIPS market, which is Treasury inflation protected securities. Mm-hmm. So you buy one of those, you don't have to worry about inflation. You're just effectively owning you're getting the real interest rate. Now going forward, I think that we could get into a little bit about why I think this dynamic changes, which ultimately affects tech. But the reason everyone's been in this is because it's been going straight lower, and that makes the multiples or the earnings of tech significantly higher because there's some growth there, or there's more growth. In some stocks there's no growth, but there's more growth than the more cyclical elements of the market.
Right. That's so interesting. I think you make the point that investors are willing to pay more for growth in a low growth environment because rates are so low. I think this another way of looking at it is that in the discount dividend model, when equity investors buy a stock, they're paying for the future cash flows, and then they discount that relative back to the future relative to a discount rate. And if that rate is low, that the terminal value of that company just can increase. And
Exactly.
if rates go zero or even negative, I mean, theoretically, the value would be infinite. Obviously, that's just theoretical.
Yes.
I want to get your view on tech going forward. So you
Yes.
think that, tell me about why you think real rates are going to increase and how that will exert pressure on tech.
Yes. So there's two things that I think are going to drive real rates here. One, if the dollar rises, and we're sort of correct in that view, because of this liquidity backdrop and positioning, your break evens are likely going to come lower because break evens are very, very commodity sensitive. So as the dollar goes higher, commodities go lower and break evens go lower. So if the view is correct, or if the assumption is correct that the dollar goes higher, break evens likely come lower. And here's nominal rates. I don't know if I can do this with my hands to make it easy, but as break evens come lower, that means that real rates rise. And if real rates rise, it unwinds this whole sort of concept that we were talking about previously with multiples in DCFs. And the reason, so from a break even standpoint, there's a potential for real rates to rise. However, from an actual growth standpoint, we focus a lot on leading indicators and what the economy is going to do over the next 12 months. All of our leading indicators and a lot of our real-time models are showing that the economy is absolutely improving and moving in the right direction. Now, COVID could throw a little wrench in that if you have your second wave, more shutdowns. But from a pure sort of cycle basis, outside of that, things are improving. Things look pretty good after we get through this liquidity period. Under that assumption, I think real rates really move. I think nominal rates could go much higher. Much higher. I mean, I think they could go to 1.5% probably in the next 6 to 9 months. After we get through this liquidity period. And then
nominal rates. Would that be in like the 10-year or
the 10-year? I think the 10-year could go. I think the bias for the 10-year from now is higher, or the risk reward profile of bonds is likely lower. After we get through this little liquidity period. This little liquidity period is next 3 to 4 months, or called through in the first quarter is making things a little difficult. But if you recall back, in October, when I launched the firm in October of 2018, our first piece that we put out was called Bonds and Chill, and rates at the time were 3.18, 3.12, around there. And we said, look, we think rates are going to go 100 to 200 basis points lower. All of our leading indicators are straight lower. It's a pretty dismal backdrop. You want to be long bonds. I think that thesis has played its course, and now we're sort of on the other side with the leads turning higher. Some of the markets are starting to confirm this. We have this real-time PMI model, which is like 35 different ratios of the internals of the market, and it's got an unbelievable correlation with the global PMI. It's very much higher. So we're the cyclical elements of the market are turning and looking much better. And I think that likely continues through 2021, which means nominal rates go higher. On the assumption nominal rates go higher, I think real rates will go higher. And you could have a situation where multiples get cut by 20 to 30%. Now, why do I think tech's going to have a difficult time? Well, even if you assume, or equities in general. So here's the thing. 70% of the US market cap is tied up in tech, equities, and defensive sort of lower real rate bets. So that's utilities, staples, telcos, and healthcare. So if you have $24 trillion, or 70% of the market tied up in these lower real rate bets, and I'm saying the probabilities favor higher real rates from two angles: one, from an economic growth slowdown, or two, from an economic growth pickup. Those assets, the multiples of those assets, get re-rated. So even if you have a growth pickup, the equity market as a headline basis might not move anywhere and actually might go lower.
I was just
because
thinking that, Teddy. Yeah,
because there's this unwind, and then another sort of way to think about it is financial conditions right now. If you look at PEs versus financial conditions, price to EBITDA, price to sales, price to book. Price to book is probably the highest correlation. Price to book relative to fin conditions is phenomenal correlation over the past 2-3 years. You can't really go much lower. The financial conditions are at all-time low. You can't go much lower than they're currently at. So in terms of a multiple perspective, you've basically taken all the you pulled all the juice forward. Now, the counter to that would be, okay, well, we're gonna have earnings pick up. Fair. However, if we assume ACWI or the global stock market earnings are at their highest level at $34 per share, COVID never happened. They were at $34, and next year, from the high, they grow 20%. If I'm right on real rates and earnings still grow 20%, the market trades flat. So it shows you the potential difficulties we have here from a headline basis, from a passive basis, which plays into some of my longer term thinking. However, there's going to be huge rotations within the market, within the parts of the world. For example, we're starting to see in energy, which I'm pretty keen on over the next, I don't know from this level, but we were keen on it. We were writing our monthly note our institutional monthly note last month. Sectors of the market in areas of the world, call it Latin America, that look very interesting relative to the US, which I think trades flat to down over the next short, medium, and intermediate, short, medium, and long term, call it time frame.
That's interesting. I want to get, we have your view now. I want to get into how you trade it. I was going to ask you about sort of which companies you select, but because you mentioned geography, that you prefer companies in Latin America, tell me about that. Why is that the case? Is it because of the emerging market currencies that make it a favorable thing, or is it more macroeconomic?
Yeah, so I want to make sure time frame, right? So just to preface this, it's long-term view that these things are going to do very well. Short-term, we might have some hiccups sort of with this liquidity backdrop that I presented. So long-term, I think I talked a little bit about that, the new age of monetary policy, whereby you're pulling cash out of the market via Treasury issuance to hand out via stimulus. That's very commodity positive. That's also probably dollar negative longer term. So if you have the dollar going lower and you have commodities going higher, that's extremely beneficial to Latin America, where Brazil, for example, is a huge commodity producer. Chile. So to me, the areas of the world that have been beaten up due to cyclicality and due to a stronger dollar, emerging markets, Latin America primarily, are the ones that are going to have very high annualized returns over the next 2, 3, 5, 10 years. So we have a few models that break down longer term valuation, call it price to 10-year earnings stream, price to 10-year sales, and the forward returns for emerging markets, Latin America, are all 10 to 12% per year for the next 10 years. While the US is going to be negative for the next 10 years, because we've had such an appreciation of the markets relative to the earnings stream, but also positioning in the US is like as a percentage of household assets, equities are a huge percentage, which typically leads to negative forward returns. So these profiles favor the rest of the world over the long term, particularly the more commodity, dollar sensitive areas of the world.
Right. Yeah. Your call that the returns of U.S. equities over the next 10 years will be 0 or negative is very bold. And yeah, there's a chart of the Wilshire 500 market cap to total assets versus forward 10-year returns that you sent me. The two lines map on each other very, very closely. I think also just one chart that comes to mind is just the massive outperformance of U.S. equities relative to not just emerging markets, but Chinese equities, European equities. Are you a believer in mean reversion in the long term in terms of like if some things can't go on forever?
I think if the factors that drove it change, then absolutely. And I think there's been a large part of this has been sort of the dollar and the dollar appreciating over this period of time. And I think we're now starting to see a scenario where the dollar could go much lower over the longer term, and that's definitely going to favor other parts of the world versus the U.S. And this constant tech bid and the amount of money that's coming into the U.S. is likely going to fade going forward. So if you have higher real rates and a lower dollar, that's very, very positive cyclicality and cyclical parts of the world. Interesting, the earnings of these emerging markets of Latin America, for example, are flat to up, and the markets are down from, call it, 2009. So from a valuation perspective, on a long-term valuation perspective, valuation means nothing in the short term. On a long-term, sort of longer time frame, these things are very much more attractive than U.S. assets, which are, max valuations on nearly every metric. But of course, that's relative to rates. So because rates are low, you can pay a higher price. However, I think going forward, that dynamic changes. Now, one caveat I want to put in here is, if the Fed does yield curve control, I think that whole thing changes. And I think if there's any hint of yield curve control, one, you want to be long the emerging market space, but two, I think the gold and gold miners, this might be a good little segue into gold, I think are just going to go to the moon. If the Fed decides to move forward with yield curve control, which might unfortunately have to be sort of the next iteration of their monetary policy. I know they've sort of talked about that they don't want to do it. They don't want to blow up the balance sheet. I don't think they really care. But I think that's likely, at the end of the day, their goal is to have real rates lower to help the economy sort of function and to sort of hold up asset prices. And if rates are rising on the long end and real rates are rising, then the way to make sure that their overall goal to have that manifest is to effectively do yield curve control. So that's something I'd be on the lookout for, that changes effectively that dynamic that I just talked about.
Okay, that's interesting. You mentioned yield curve control. Could you define what that is, and specifically like what actions the Fed does, like what maturities the Fed is sort of targeting on the U.S. yield curve, and how that impacts the asset classes that are within your thesis?
So what they would do is they would say, look, the 10-year is not going to go above 1%. So even if you have a global growth pickup, and rates should be rising, call it to 1.5%, 2%, they will buy the 10-year, effectively holding rates at 1%. Now, what that means is that real rates likely go much lower, way lower, because nominals can't rise and break evens are probably picking up as growth is improving. And that means that people can be willing to pay way more for an equity, or the DCFs of an equity or higher. However, what's interesting is I still think tech on a relative basis does poor there, because if you're willing to pay more for, and then you also have cyclical earnings power, I think a lot of the cyclical sectors and areas of the world do well. So tech, even in that scenario, I think has a difficult time.
Right. Okay, that's really interesting. Now let's turn to gold and precious metals, because you mentioned that this environment of a weaker dollar and yield curve control would be very, very good for gold. We've had quite a run in gold. It's been, it burst past the 2000 level. Now it's about hovering just about over 1800. What is your view on gold? Can you describe like your base cases, why you find it attractive, sort of in a vacuum, and then what do you see now on the horizon? How does that shape your outlook?
Yeah, so I came on with Raul in like June of 2019 or something. It was like gold miners versus banks was my favorite trade. And at that time, it seemed that rates were going to go much lower. Real rates were going to go much lower. And the backdrop for gold was phenomenal. That sort of changed over the past, call it 4 or 5 months ago, where I started thinking about this real rate dynamic and the potential for a economic pickup. So right now I'm sort of neutral to negative on gold. I think it's pulled back a little bit and is essentially factoring in or thinking about higher real rates and an improving economy. So right now it's also a pretty negative seasonal period. So through the end of the year. So for the time being, with liquidity, with my view on real rates, I think it's better to look at different parts of the market, likely different commodities than gold. I think it's just going to have with this backdrop that I just talked about with real rates, I think gold's going to have a tough time until the Fed comes in and does something crazy, which is basically their job and what they're known to do.
Yeah. You mentioned your interview with Ral. Since then, gold has increased 60-70%. I actually don't think that has been your best call. It's in Real Vision history. I think your best call was when I interviewed you in May behind the camera, and you were very bullish at Bitcoin. I don't even know what Bitcoin was at then, about maybe 7,000-8,000. Now it's it's more than doubled since then. So you've been a Bitcoin bull. I think that's fair to say. Is that fair to say?
Absolutely, yeah.
Okay. Oh, what's your view now?
Yeah, I'm sort of neutral now. I think just the amount of sentiment and positive sentiment surrounding the space is making me a little cautious. I mean, I think long term, I think with Bitcoin, you need to think long term, and I think long term it's going to be much higher. But from a sort of my trader hat and trader mindset, right now we're going parabolic, meaning the rate of drawdown or rate of decline on the asset is progressively lower. And we're now at a point where we're effectively just going straight higher. And if that arc breaks, it typically signifies the end of a trend and sort of, a consolidation period, or a new trend. So I think, short to medium term, I'm sort of neutral to negative, but then a long term clearly bullish. I just think it's had an unbelievable run and it's gotten ahead of itself. A lot of positive news from large from PayPal, from institutions buying it, from PayPal allowing individuals to purchase Bitcoin, and maybe it goes up 100%. That's probably what it's going to do now that I said this, but I don't know. I think the risk reward is not amazing, but I don't think it's probably not the best asset to trade. It's more of one to own. So we've pared back a good portion.
Yeah, I was actually just about to ask whether you had been managing your position. Do you think you'll continue to buy if it goes down? Like, will you be buying on the dip?
Yeah, absolutely.
Yeah.
It depends on the dip. 5, 10, probably not. But if you have a decent dip, then absolutely.
Okay, interesting. So it sounds like your view on gold and Bitcoin is kind of the exact opposite of the dollar. On the dollar, you're long-term bearish but short-term bullish. On gold and Bitcoin, you are long-term bullish but short-term, maybe bearish is a little bit too extreme of a word,
Neutral.
But you're not excited about it short-term.
Yeah, exactly. And I think you nailed it. That dynamic there with the dollar going higher I don't think is great for either asset class. And I think long-term, the dollar is likely going to go lower, which is very good for both asset classes.
Yeah, I mean, I think there's so many people in the world talking about Bitcoin and gold, and anytime they have a negative view, I always listen to them. But if there's someone who sort of has a track record of calling people gold bugs and just really being a Bitcoin hater, I think that is you take that with a grain of salt. But for someone like you, who's been not only has been in the space of investing in gold and Bitcoin, but has also made a lot of money for it, both for yourself as well as your clients. I think you saying that you're not so bullish on it anymore, that says a lot to me.
Yeah, everyone, even a blind squirrel finds a nut, but I think the dynamics of the things that drove it and the thesis that we sort of laid out, the facts on that thesis have changed, and when those facts and the economic backdrop change, I think you need to sort of adapt to it and move your feet. So the backdrop right now, I think, is not as positive as it was during those. So basically the probabilities of those scenarios happening, or those theses manifesting, has come down significantly. So it's all probabilities game, and I think you need to be careful. If the probabilities start to not shift in your favor, don't force something that doesn't favor, that's not in your favor.
Okay, I have a question, which is, it sounds like you think it's just a overbought space. Maybe if not technically, then just in terms of it's, everyone knows about it. The easy money has already been made, at least for the short term. Could you contrast that with just, before this interview, you kindly sent me your October note for Pervalle, and you said that it's become even more evident to us that the new monetary regime is increasingly positive for Bitcoin. Could you describe that logic? Is it basically that central banks are going to print so much money and it's not going to be able to get in the real economy, so a lot of it is just going to sort of sizzle off and go into assets that are stores of value like gold and Bitcoin?
Yeah, exactly. I think ultimately, back to sort of what the Fed's trying to do. At the end of the day, they're trying to get real rates lower. That is their goal, to allow sound monetary policy and flow of credit, and have corporations be able to finance it on a real basis at very low rates. If that is ultimately their goal, then they're going to do everything they can to try to get real rates lower. And we know that real rates correlate very well with gold, unbelievably gold. And the thesis and overall idea also correlates with Bitcoin. However, Bitcoin's a much smaller asset class and has a lot more runway versus gold, which is, $10, $11 trillion asset class that's already more established. So Bitcoin could, relative deviations to, call it, real rates, could have much more upside or deviations, exactly what's going on now. But the thesis and sort of idea is the monetary policy is going to get even more crazy, because now you're not able to lower. I think we're going to have one more sort of upturn with the lowering of rates. And then after that, maybe they hike, probably not. I don't think they're going to hike for a while. And if they don't hike and then we have another slowdown again, then they're not able to cut rates, which then means they have to get crazy with monetary policy. If they have to get crazy with monetary policy, then they're probably going to do something pretty crazy, which is very bullish for something that is it's effectively a hard asset. There's only so much supply of it, versus financial assets, which, so Bitcoin versus hard assets, I think Bitcoin versus financial assets, I think does amazing. And then as the Fed gets more crazy, I think it will do very well in those environments.
Okay, interesting. Yeah, I think when you have a fixed asset that's denominated in an asset that increases every day, I think most people can sort of wrap their head around that argument. I just have one question about monetary policy. Throughout this year, in response to the COVID pandemic and the corresponding economic shock, the Fed has been buying a lot of mortgage-backed securities as well as Treasuries. That has sort of been the lifeblood that has fueled this rally, in my view. But the thing that has got the headlines has actually been things like PPP, the municipal, credit line, commercial credit liquidity facility, sort of these emergency lending programs that the Fed initiated in March and April. But actually, they haven't been used that much. I think about 20 to 30 billion of all these programs have actually been used, which is a lot of money, but not in comparison to sort of the $500 billion of repo that the Fed sells every day. Not that there actually is any uptake on the repo. But I want to ask your question on two things. Number one is that these emergency lending programs are likely to not be rolled over. They will end on December 31st. I think all 8 of them, actually 8 of the 9 of them, will not be renewed, and they will end on just the end of the year. Even though they haven't injected liquidity into the market, has there been a psychological benefit that, you saw the headlines of, the Fed is going to buy high yield bonds, high yield ETFs. They haven't actually really had to pull the trigger. They've only bought, a few billion here, a few billion there. It's been the psychological benefit that the Fed is going to have their back. Going forward, if the Fed doesn't have their back, what do you think that will portend for credit markets?
Yeah, well, I think getting it, if it rolls off, you then need to reappropriate. The funds get reappropriated. You didn't need to basically pass through Congress more funds for those programs. And now that the House and Senate is split, it makes it more difficult for potentially to put these programs back on, which I think is a good thing. I mean, the programs themselves weren't even used, right? To your point, it's very psychological that the Fed's there sort of supporting your back. And what's going on in the credit space is just absolute bananas and bonkers, which is why you see financial conditions at the best levels that they've ever been historically. So, thinking in risk reward every day, right? The risk reward there is very, very poor. Where you have currently the best financial conditions ever. If today is the best ever, where do we go from here? Right. So the fact that they rolled that off, I think is in relation to the credit markets and credit spreads, I think is sort of interesting. And they can't really have the backs now unless it gets passed by Congress to source additional funds for those programs after the end of this year, which could potentially have some psychological effect on the credit market. So I think the risk reward for credit spreads, even though I think the economy is going to pick up, I think the risk reward is higher, or meaning I think credit spreads are likely to go higher, which means financial conditions weaken, which means multiples weaken. So we're in a situation where you have an unbelievable, you have some of the best, unbelievable, unprecedented liquidity that's sort of starting to fade, best financial conditions ever, lowest credit spreads that we've seen in a while. It's just a poor sort of setup for risk assets, which is also why I think commodities and these other parts of the world that don't have a huge technology exposure will likely do much better on a relative basis.
Okay, interesting. You said it's a poor backdrop for risk assets, so bad for bonds, high yield.
Yeah, that's probably the poor way to phrase it. I think on my part, I think it's meaning it's the best possible. So if right now is the best we've seen in terms of financial conditions, how can we get, how can you improve from that? Right. The risk seems that it would then be financial conditions would worsen, which means multiples would be compressed.
Right. Okay. So I think I've gotten a very good sense of your views, your theses going forward, both on the 2 to 3 month horizon, as well as the 1 to 2 years, as well even 10 years. I think what I want to know now is, how do you trade those views? I was going through your fund's prospectus, Pervalle Global, and obviously I can't disclose anything on camera, but it seems like you are actually net short equities, and then you have a little bit of an allocation into bonds, into currencies, and then into commodities as well. So I just want to delve into that. When you were short equities, I guess, number one, do you buy put options on them, or do you sort of do a pure short where you borrow them and sell them? And then how do you go about managing positions as well as the correlations? Like, can you talk a little bit about that?
Yeah. So overall, I think the risk reward, so the net equity is primarily negative tech versus positive on the more cyclical areas of the market. So I think being net short, we'll call it, say it's 2 units short of tech versus 1 unit long of cyclical. And recently that started to work out.
Yeah, it has.
So you could put on 1 unit of, for example, energy, and it could go up 3x while, tech only goes up 1x, and you make the spread. I think on the equity side of thing, I think it's just for me, one, you need to look at the more cyclical parts of the market, but two, I think overall from a risk perspective, I think the next few months are just sort of a no touch and sort of be cautious. And then next year it's very clear that we'll likely have a cyclical rebound. Right. And what that means for the market is going to be a little more tricky. I think the areas you want to be looking at areas of the world that do well during a cyclical upturn. I think bonds probably become an underweight, big underweight, likely short.
And sorry, when you say bonds,
now
are you
to
talking,
next year.
Sorry, when you say bonds, you're talking treasuries,
U.S. 10 years.
sovereigns,
Yep.
investment grade.
U.S. 10 years.
Okay.
U.S. 10 years. And the bond exposure that we've had was primarily been emerging market local currency bonds, which you get exposure to the currency from. But the way we're pretty active, so we'll take a core view, call it for the intermediate term, and then trade around that view. So sizing up, sizing down, different sort of ideas. But everything I just said, I could, other than the long-term stuff, I could change my mind, tomorrow and have something totally different. So don't look at that and think of that like we should go out and do that.
I got you. And I've got a question. How in the weeds do you go? Like, let's say we say, okay, short 2 units of tech, long 1 energy. Are you shorting the FANG? Are you shorting the Zooms and the snowflakes? Like,
yeah.
How high of a price to book multiple or price to sales multiple are you aiming for?
Yeah, it could be anything. So we've had on, and they're currently looking at like Latin America versus non-profitable tech. So those are the Zooms of the world. The things that have really run that definitely do not do well during a cyclical upturn that everyone is currently crowded in. The FANGs, Qs, the futures, anything with a ticker effectively. On the tech side, we've sort of, taken a look at or thought about.
I like that. And then my corresponding question is about energy and these sort of distressed sectors, mm-hmm. like, energy, commercial real estate, cruise liners, airlines. One thesis that I've had is that if things get really bad, a lot of these companies could go out of business, but that actually could be really good for the dominant player in the space, the people with the strongest balance sheets. So mm-hmm. my question is, are you allocating capital across companies throughout this? Are you investing company in the more distressed companies, or are you aiming to find those ones with the best balance sheets, even if they are priced more richly?
Yeah, so we probably look less at individual companies and more sort of sectors. So mm-hmm. Much more of the ETF based stuff, unless we have like a real high conviction. I think I don't know as much about the distressed areas such as the cruise lines or the airlines. Airlines are sort of intriguing, but energy, for example, we've done some work on. I just think it was washed out. Everyone, on a Biden win, energy was going to go away. Energy will always be around. We're never going to be able to fly an airplane with it. We're never going to have an electric airplane or be able to, drive a electric car to the top of a mountain. So, this is a sector that's not going away, that is necessary, that we need. And interestingly, the supply demand dynamics for 2021, 2022, I think are unbelievable. Probably the best that they've been. If you look at, I'll send you this chart. If you look at CapEx of E&Ps, basically the CapEx to E&Ps relative to their total assets, it's been dismal. So there's been effectively minimal new projects coming on, which leads crude returns by about 2 years. So the forward returns of crude are unbelievable. The demand side, you're looking marginally down on the gasoline side, marginally down on the diesel side. Jet fuel has gotten crushed, but now that you have a vaccine, if jet fuel comes back, on the supply side, we're now looking at really negative supply coming forward, but also inventories are back sort of in their historical average. So if you have any pickup on the demand side, you start getting huge draws, which then creates the supply demand dynamic for the energy sector next year in 2022, I think is phenomenal. And the stocks have been completely bombed out. No one owns it. Right. So it's like I was talking about before, it's a $600 billion market cap between the Russell and S&P. Mm-hmm. And you're looking at 24 trillion for all of this deflationary lower real rate bets. Any type of rotation out of that needs to find somewhere to go. Likely not going to be bonds. And it's coming out of tech, maybe commodities, but these cyclical beat up sectors that everyone hates, no one wants to talk about. Honestly, it was sort of they went down every day. So it became a point where if you owned it, it was performance risk or almost business risk at a point. And I think that capitulation the other day, and then with the vaccine, is created a positive tailwind for the space. It's moved really far, really fast. So, maybe in the near term, today might not be the best place to enter, but over the next year and a half, I think energy relative to tech is going to do very well, given the pickup in global growth that we see, the supply demand dynamics, and just positioning that everyone currently hates it.
Interesting. Could you give us any tickers? Is it XLE or XOP?
Yeah, anything with XLE. IXC is the international one. With that, you also get you have less tax risk exposure. So if there's a change in the tax structure in the U.S., you're less exposed to that. It's primarily international. There are some U.S. companies. You also get negative dollar exposure over the long term. So that's also could be a positive benefit. So IXC is another one. But again, they've moved really far, really fast. So we'll see what happens over the next few months.
But they still could have some room to run because they're still well below where they were in February.
Correct.
Right?
It depends on your time frame. So whatever your time frame is, if your time frame is 2 years, then I think they're interesting. If your time frame is 2 to 3 months, the less interesting.
Okay. I'm looking at your asset allocation. I know this is months earlier, but you've got a healthy size in commodities. Now, I assume that when you own an energy stock, that would count as an equity. So when you own a commodity, is that Bitcoin or you're owning GLD? What is that?
Yeah, it could be any commodity. So it could be sugar, it could be crude, it could be gold, silver, that type of thing. It could be silver miners, gold miners. That would fit in that bucket.
Okay, got you. But you feel not super confident about gold, silver miners in the short term. Would you say your highest conviction trade is this energy trade that you talked about?
Highest conviction trade. That's interesting. I think highest conviction trade is probably higher real rates.
Okay.
So you have to put me to a time frame, right? So if it's the next week, no clue. Next month, 2 months. I think over the next year, I think higher real rates is probably the higher conviction trade.
Understand. Well, Teddy Vallee, thank you so much for your time today. I've really enjoyed speaking with you.
Awesome. Thanks, Jack.
I hope you enjoyed this special episode of The Interview, the premier business and finance series in the world. However, this is just the tip of the iceberg. For more in-depth content and expert analysis, visit the membership link in the description to unlock a week's access for only $1. This dollar can change your life.